Joining me now is Gita Gopinath, Harvard Professor of Economics and former first Deputy Managing Director at IMF. Professor Gopinath, thank you very much for joining us on ET now. To begin with, I want your assessment on the entire West Asia crisis. And for a country like us, where we are dependent so much of fuel from the West Asia, what kind of impact will that have on India?
So the West Asia situation is clearly still evolving, and we still have the blockade of the Strait of Hormuz. And so, in addition to prices of oil and gas and fertilizers and helium and sulfur and many other commodities prices having increased, you basically have shortages of some kinds of commodities, like for India, in the case of cooking gas, LPG, the shortages that are coming because there's simply just no ships taking fuel out of the Middle East into, for example, India. Among the countries in the world that are most directly impacted by the developments in Iran are basically are India. I mean, India is one of the countries most impacted because it relies on imports of oil and gas and fertilizers from the region, but also because it relies on the Middle East as a supply chain hub. It's what India uses to send goods to other parts of the world, and also because of the reliance on remittances. So there are multiple channels through which this is affecting the Indian economy. I mean, growth is expected to be around 6.5% for the Indian economy this year because you have this negative effect that's coming from the war in the Middle East. Some of that has been offset by the lower tariffs now that India has. It was supposed to be 50% that the US imposed on India, and now it's down to 10%. But still, you do have the negative effect that's coming from the war. And again, this is a developing situation. So, depending upon whether this crisis lasts for a few more weeks, you could see an even larger impact on the Indian economy.
Some would argue that this oil shock is a little different from the previous one, where we saw oil jumping three times or four times the price. At that point in time, the supply side impact was only 7%. Now it is around 20% of the global crude requirement, which goes through that Strait of Hormuz. And still, we don't see the kind of spike that we have seen in oil. Is this a different kind of shock from what we are used to see whenever there is an oil shock in the past?
So what we've seen differently this time is that it's not just firstly that the price of some of these commodities have gone up, but also just simply shortages in terms of supply availability, right? I mean, if you could get ships to move through the Strait of Hormuz, you would get them and you would get some more supply on the market, but that hasn't been happening. I mean, the last time round in 2022, when you had Russia's invasion of Ukraine, the biggest increase in prices came from natural gas, and that came for Europe. I mean, that's a very segmented market, a fragmented market. Not all parts of the world are equally affected in terms of gas prices. But that was a very different reliance that Europe had on fuel coming from Russia. This time it's a different matter. There's also been a lot of diversification thanks to the 2022 episode. Countries have moved and buy their fuel from many parts of the world. We've also seen a shift towards renewables in many parts of the world. So all of that is helping. But we're definitely not out of a difficult place at this time because we still have a blockade and it's still ongoing. And we could still see accidents in the Middle East that could lead to much more longer term disruptions. Also, what's compared to 2022, what was different was that it was not just that there was a supply shock and there was lesser commodities available, but that was a time, if you recall, that we were coming out of the pandemic lockdown. So demand was surging, and that surging demand met lower supply. And so that's why you had prices go up much more than what we're seeing right now. Right now, we don't have that big demand surge.
What is your assessment of how it's going to impact India in the medium term, especially from the point of view of food, or maybe fertilizer and fuel?
Yeah. Now, the concern is, of course, that if, again, this war doesn't end soon, then again, shortages of fertilizers will affect the crops, the sowing season, and will affect agricultural output several months into the year. That's what we saw the last time too, and you can see that prices could go up in the future. Right now, because there are some contracts that were set, there were longer term contracts that were set previously. Those kinds of price effects are not showing up, but it usually comes with a lag that you start seeing an effect on food prices. I think one of the things that India has done well is to increasingly rely on renewables, and that's helping. And I think this crisis tells you even more the need for energy independence and ramping up even further and at a faster speed, being able to rely on renewables, especially on solar being a very important part of that. That will help further insulate the Indian economy against events of this kind.
And in your opinion, how is inflation going to take shape after this entire shock? Do you think we are yet to see the second order impact percolating down to many industries at this point in time? Is just so the primary industries which may be impacted or they are able to get a alternate to crude or natural gas. But do you think that inflation would be much more than what the RBI is estimating at this point in time?
So at this point, just from a consumer's perspective, you aren't seeing the effect on inflation because you are not seeing the increase in those prices in terms of, when you're filling your fuel tank. You don't see, it's not, that hasn't been passed through yet. So a lot of it is being absorbed by the companies importing the fuel. This is not sustainable. At some point in the near future, I would expect that there will be more pass through of this into consumer prices. And this is it will show up, not the full effect, they don't pass through, but there will certainly be more pass through into prices than what we have seen. It's already a fairly big stress on airlines because the cost of jet fuel has gone up quite a lot. And while some prices have gone up, that's still a fraction of the amount by which jet fuel costs have gone up. So I think those companies are getting hard hit at this current moment in time. The spillovers, the further rounds of spillovers to other areas will depend upon what happens to inflation expectations. The good news is that inflation expectations in India are well anchored. And so while we could have certainly a period where headline inflation goes up, but that could be transitory and not further feed into second round effects through higher wages and then pass that into higher core inflation.
In your view, do you think that the Fisc has enough headroom to manage this kind of shock, or it has to be at some point in time passed on to the consumers as well?
Oh, some fraction will certainly, I expect, will be passed on. Not all of it, but some fraction will be. Some fraction will be absorbed by the intermediaries. Some part of it will be absorbed by the government. So it's about a third, a third, a third. I suspect that will be how the cost sharing will happen. It's going to be difficult to absorb this kind of a shock because, compared before the Iran conflict, oil was averaging about $70 a barrel. Now it's expected to average about $85 for the rest of the year. And again, if the current deadlock continues, we could end up with oil going up even to $100 for the year on average, and that would be a much bigger hit to not just the Indian economy but to all economies everywhere in the world.
And how do you see that impacting the balance of payment? Because for the last 4 to 6 quarters, we have a deficit in balance of payment. Is that going to be a big worry for you as an economist?
The most immediate effect that we are seeing will be on the balance of payments. Now, the balance of payments, the current account deficit of India is not very large or anything. It's about 1% of GDP. But at the same time, I'm looking at the kinds of capital flows, the behavior of capital flows into India, because those are not very strong, there has been pressure on the rupee. As the deficit grows because of this higher import bill from these energy imports, you will certainly have more pressure in terms of the balance of payments and therefore more pressure on the currency. I think given that this is a fundamental shock, we should expect to see that that the currency would depreciate, and that would be a very reasonable thing to happen.
And in the past few weeks, we have seen the Reserve Bank of India taking stern measures to stabilize the rupee, and in many cases, get the rupee back from 95. Do you think that it's going to be a tough task for the central bank to bring in some stability for rupee?
If the concern, if there is evidence that the exchange rate depreciation, the weakening of the rupee, is de-anchoring inflation expectations, or if it is generating financial turbulence, and you can see that in certain kinds of spreads, market spreads, then of course there is an argument to intervene so to prevent that from happening. But in the absence of those forces, and there's at this point not that much evidence of either of them playing a role, letting the currency depreciate is the best way to insulate the economy. Again, of course, as any central bank would do, paying very close attention to any kind of speculative behavior in the currency market is going to be important to make sure that it's not speculation-driven depreciation of the currency. And there are ways to do it. There are very different metrics to look at to figure out whether that's indeed going on. So some of the steps that the RBI has taken is in line with preventing that kind of speculative behavior. And of course, that's well taken.
How do you assess India's current reserves as we speak? $700 billion, but some market watchers will argue that RBI also has $120 billion of forwards. So if you look at from their perspective, it's around $580 odd billion which we have in reserves. Is that enough to manage this kind of shock from a medium-term point of view?
That is a healthy level for a country's reserves. What's important to keep in mind is what you do with those reserves. So if you are going to use the reserves to very actively move against a currency, trying to preserve the value of the currency, then of course you could start running down those reserves very quickly. So it's an adequate amount of reserves. It's a healthy level of reserves for India, but one still has to be very careful about using it, because you could, of course, run it down very quickly, but there's no reason to run it down at this point. There is, again, like I said, well-anchored inflation behavior, nothing major in terms of financial market turmoil. And so the right approach would be, yes, this is a good reserves to have, and to only use it pretty cautiously.
Ms. Gopinath, one of the lessons from COVID was to have an alternate supply chain so that you don't have that kind of shocks from a supply point of view. What would be the lessons from this kind of shock which is coming through for a country like India? Of course, energy security is one of them, but beyond that, how do you go about ensuring that future shocks are not going to have this kind of impact?
A few things. So one, like we discussed, energy independence is very important, building up energy security and moving towards more renewables that can be produced in the country, going to be very valuable. That's super important. Second, and this is true for all countries, which is good macro policies in peace times when there are no wars, is always super helpful when you are in a turmoil or a crisis, because you have the reputation, you have the credibility that helps you. And very specifically, the fact that India's inflation was well within the bands, the fact that inflation expectations are well anchored, is giving the central bank a lot more leeway in terms of what it can do with its interest rate policy. Similarly, on the fiscal front, I think that the central government has been very careful about the size of the at least for central fiscal deficit, and that is also extremely helpful. So this approach where in peace times or when things are just normal, that you have good, high quality macro stabilization is super helpful in times of crisis. That's, I would say, is another lesson to take away.
Last year, we had this entire tariff issue. And this year now you have the West Asia crisis, and prior to that, the central banks were in a mode where they were trying to ease from a monetary policy point of view. Do you now think that central banks will be, on a pause as far as interest rates are concerned, and in fact, if inflation inches up, there could be a tightening as well?
I think for most central banks in the world, you're in a slightly more hawkish place with respect to monetary policy than you were before the Iran conflict. It doesn't mean the central bank is going to rush to raise interest rates right now, because again, unlike right after the pandemic, when you had the surge in demand that came at the same time as supply was restricted, you don't have that big surge in demand right now. So you can afford to be cautious and you can afford to wait. And what's likely to happen is that central banks were previously going to cut interest rates, may be a bit on hold. So, for example, the U.S. Federal Reserve will likely be on hold for longer than it would have been, unless they see real signs of strain in U.S. labor markets, which you really don't see at this moment. So there's a bit of a shift overall towards a more inflation fighting stance at this point globally. But I don't think that central banks are rushing to raise interest rates because, like I said, it's quite different from what followed the supply shocks during the pandemic.
For the last 4 or 5 years, we have been the central bank, means the Indian government has been investing a lot in capital expenditure. With this kind of shock coming in, do you see that getting impacted in any way? And as a result of which, the growth which is led by the capex cycle, which is coming in, slowing down a bit?
I think it's important not to slow down capital expenditure. I think that's critical for the Indian economy. It's critical for growth, and we know that the fiscal multiplier on capital expenditure is significantly it's large. It can be greater than 1 in many cases, depending upon how it's spent, and therefore that, in a sense, helps to pay for itself. So it is important in general, to push ahead with physical capital expenditure spending. It's more the other kinds of discretionary spending which are not of the capital nature at which you have to look at more carefully and see how not to increase the fiscal deficit because of that. And so in that particular case, the kinds of fuel subsidies that right now have to bear if it doesn't let more prices show up at the pump, those are too big. There will have to be some pass through to consumers.
There's another thing which is a trend which has come into after the West Asia crisis is the kind of defense expenditure which many of the countries are now increasing across the globe, whether it's European countries or whether in India as well. Do you see that having an impact from an economy point of view? That the focus is now to ensure that you have more defense preparedness for events or eventualities?
That is indeed a fact. Countries all over the world right now are looking at increasing defense expenditure. We've moved away from multiple decades of peace and the peace dividends. I think countries are now saying that we need to have more in terms of defense preparedness. But the approach for that will have to be to make sure that it's not just something that you finance through borrowing, because when you increase defense spending, it's not a temporary thing. Usually maintaining a bigger defense force requires ongoing spending. So it's not just a transitory one-time spending that you have to do. So at least over time, it is important that either the government finds new revenues to finance this higher defense spending or cuts expenditure somewhere else. The extent to which all that defense spending is going to stimulate the economy depends upon how much you just spend it on imports. If you're basically going to buy foreign weapons or foreign aircrafts, then in that sense, the stimulative effect on the domestic economy is not that large. But if you have a defense industry and you are using the domestic defense industry to make your purchases, then you get a bigger stimulative effect. And also, if you're using it to do R&D, and a lot of very important R&D has taken place through the defense build-up, that, of course, can also generate a more stimulative effect on the economy. But I think the important lesson to keep in mind is that defense spending, when you're increasing your defense spending, it's something that's going to happen on an ongoing basis. And you just simply can't rely entirely on just borrowing to sustain it.
For the past many years, the Indian government has been very prudent with respect to the kind of fiscal deficit targets and meeting it every year. And this year, we were trying to do a move away from fiscal deficit to debt to GDP ratio. Do you see that now under risk, given the fact the kind of measures that Fiscal may have to take to support the economy?
These are always difficult trade-offs that governments have to face. And indeed, especially over the last few years, with the numerous shocks, a challenge. But again, I think India has done well at the central level, less so at the state government level, but at the central level, done very well in trying to maintain fiscal deficits within certain limits. And there's good reason to do that, because indeed, after, we are seeing shock after shock hit countries, and India's debt to GDP has gone up quite substantially compared to pre-pandemic. And therefore, it's important to bring it down so that whenever you have some resources left for the next time you're going to have a major event like that, which will happen at some point. So building up buffers is very important. Also, reducing your interest expense is going to be very helpful. And for that, having a debt to GDP that's on a downward trajectory is going to be super valuable.
And is it okay for the government to look at little relaxation to that fiscal discipline at this point in time? Because even though it may not be a COVID time, but it's again a shock which will have multiple layers of impact across the economy, maybe not just primary but second order impact, and to the MSMEs and other consumers as well?
It is important to recognize that the country is being hit by multiple shocks pretty much every year, as are many other countries in the world. And so therefore, in a sense, this is now business as usual to be in this volatile, shock-prone environment. And it's no longer possible to say, well, this is extraordinary, so we can do something extraordinary for now and not worry about the fact that the deficits will increase and debt will increase, because in the future, we will be back to ordinary times, and then we can bring debt to GDP down. These are, I would say, normal now events that everybody should prepare for. Of course, there's always scope to have some small increase in fiscal deficits. None of that is going to move the needle that much in terms of, it's not going to create big concerns if the deficit were to increase somewhat by small amounts. But again, the basic principle that this is somehow the new normal, where you're going to have multiple shocks, and accordingly, your policies have to be in line with this new normal, means that, yes, you can use some amount of space to increase deficits, but there's not that much to play with.
Gita Gopinath, it was a pleasure talking to you and getting your perspective on the West Asia crisis. Thank you very much for joining us today on ET Now.
Thank you.